Hey guys, Steve here, and in this video we're going to be taking a look at a fourplex wholesale deal that I received, and I'm going to walk you through the process that I go through as an investor, crunching the numbers to determine whether or not this is a deal I want to pursue. Stick around. Okay guys, so one of the first things you always want to consider is subscribing to my channel. Okay, you know I had to throw it in there somewhere, but okay, seriously though, one of the first things that you always want to consider is hitting the like button. Okay, I'm done, I promise. So here's the thing with wholesale deals. You may or may not know that they're a little bit of a sensitive subject for the wholesaler and for the seller. So in this video, I'm not going to be disclosing the actual address or general location, but I will tell you this. This property is located in California. It's a fourplex, and it is currently listed on the market for $400,000. Now, it hasn't been getting a whole lot of activity, so the wholesaler has stepped in and is now trying to wholesale the property at $365,000. Okay, so right off the bat, what does this tell you? California investors, what do these numbers tell you? This property is listed for $400,000. It's a fourplex. That means that each unit is $100,000, or at a wholesale price, $90,000 a unit. To me, immediately, that tells me that this property is in the hood. Or maybe it's out in the middle of nowhere. Or probably the winning answer is it's in a hood in the middle of nowhere. Now, it's possible I might be wrong, but I don't think I am. Here's the thing. I live in a pretty decent area of Sacramento, California, where a fourplex in this area could go for anywhere between $800,000 to $2 million. What does that mean? That means that the average unit price is anywhere between $200,000 to $500,000. So, and wherever you are in California, if you can find something under $100,000, you might want to look a little deeper into the property because there's something going on there. Also, there's a nice little feature that I like to use on realtor.com that allows you to look at the crime in the area. And guess what? When I looked up this property, it turns out that this area is riddled with red, which means this is a high crime area. Now, does that mean that this is a bad deal? No. It just means that we're dealing with a D-class property in a D-class neighborhood. And if you're a D-class investor, this might be starting to sound good to you. But here's the thing with D-class deals. If I'm gonna deal with a D-class deal, there better be D-class money. In other words, if I got to deal with headaches in the hood, that's fine, but the money better be good. So if you're currently saying, okay, D-class property, I'm okay with that. I'm in the hood, I might get shot, but I got my CCW, I'm okay with that. Well, let's break down the numbers. In multi-unit properties, one of the things that will help you to determine whether or not this is a good deal is the cap rate, or the capitalization rate. And generally, this will show you the returns, and a lot of investors call this also the risk rate. In other words, if a property has a high cap rate, it has high returns, but probably high crime and probably high risk. If a property has a low cap rate, it has low returns, but probably low crime and also low risk. So what kind of cap rate are we looking for in a D-class property? Well, that depends on where you're at and what your preference is, but usually you want this number to be higher if you're going to be going for a D-class property. So you're probably going to want something like, I don't know, 15%, 12%, usually at a minimum 10%. If it is any lower than that and you're dealing with a D-class property, I don't think so. So I went on to hotpads.com and I took a look at what the going rents are for this area. All of the units are 2-bedroom, 1-bath, and it turns out that the average rental for that unit is $925 a month. Insane for California. We are probably in the hood in the middle of nowhere. The units in this property are renting for $800 a month, so they are below market value, and also 3 of the 4 units are currently rented One of them is vacant. So what does this mean? It means that we are in an area that is a D-class area. We already have low values, and now we have a property that has units that are below market value that's already low, which means that this on paper is going to show very poor NOI, or net operating income. It's going to show that there is a low income that's going to be produced from this property. And what is that going to do? It's going to push our cap rate down. Without giving too many details, just to let you know, I ran the cap rate on this, and I don't know all of the expenses that go into this. I just simply went off of the taxes and insurance. Didn't include property management or maintenance or any of those things, or repairs that need to be included on this property. Just based off of that, we are already, with those numbers, coming in around a 5 or a 6% cap rate. Now, does this mean that this is a bad deal? No, it doesn't mean that this is a bad deal. As a matter of fact, there's a lot of room for potential. But it means that this is not a good deal either. And a seasoned investor, a veteran investor, will take a look at these numbers, and they're going to make you pay for this deal. As it is right now in its current condition, with its current asking price, only 75% occupied, rents below the median, and it needs repairs, I would not touch this deal with a 10-foot pole. Now let's discuss cash-on-cash returns for this investment property. You're going to need to probably put around 20% down unless you're house hacking. And in order to do that, you're going to need $73,000 for the down payment, plus let's just say $3,000 for closing costs. So you're going to be all in to get this property, just to get it, at $76,000. Now, as I mentioned, I don't have a whole lot of details on the expenses that go into this property, but let's just assume property management is 10%. I saw that the taxes is going to be roughly $420 a month, and insurance, I'm just estimating maybe $100 a month, probably more. That's just what I got off of a payment calculator. So based off of this payment calculator that I had, it said that this property at a 30-year fixed loan, I think it was like at 5% or whatever, with all the numbers tallied up, your mortgage payment every month should come out to around $2,100. Now keep in mind, we have 3 units that are being rented out at $800 a month. 800 times 3 is $2,400 a month. But that $2,100 mortgage payment does not include property management, does not include landscaping, maintenance, repairs, or anything like that, which pretty much puts us at close to no cash flow. If we did not include any of those expenses, we're at $300 a month. $300 a month times 12 equals $3,600 a year. At $3,600 a year divided by our $76,000 investment, that gives us a cash-on-cash return of 4.7%. Now, this is just me, everybody's different, but at 4.7% return, I'd probably invest my money in the stock market. With $76,000, I could take that money right now and go into the central United States Midwest markets, and I could buy an entire ready property for $76,000 cash, and then cash flow positive every month, anywhere from $600 to $800 a month with no mortgage payment. I could have a vacancy and have no payment to make. So for me personally, if you're going for cash flow and you're looking at cash on cash return, a lot of times California properties aren't going to match up to what you will see for rentals in the Midwest. So for me personally, at these numbers, I would not invest in this property for cash flow either. Now let's take into consider appreciation. You might be saying, Steve, well, it's California, there's a lot of appreciation that happens. Yes, but however, let's think here, are we gonna continue to see appreciation in California? Let me take a look at my crystal ball and see what it says. Nobody knows how long the appreciation is gonna last in California, but I can tell you this, we have been seeing appreciation ever since the recession. So about the past 10 years, the market has steadily been going up. Do you think that it's going to continue on this cycle for an additional 10 years? How long will this continue? At some point, the market has to stop appreciating. It'll stabilize off and it might even decrease. if you're going for appreciation, then in that case, you might want to reconsider at this point in the market cycle. Now, I know you might be saying, well, Steve, that's at 75% occupancy. Let's get that up to 100% and the numbers will look much better. Yes, but an investor that is purchasing this property is going to run it based off of its current rent roll. So you're gonna need to get a fourth tenant in there right away, because investors do not purchase properties off of their potential value. They're gonna purchase it off of its current condition. So what would be my suggestion to the wholesaler on this that sent me this? I would tell you this, that if you have a buyer's list and you have buyers that are ready to purchase this property at the wholesale price, I highly recommend that you get this into contract and get it sold right away. If they see the value in it, go for it, make it happen, because this property does have the potential to make a lot of money. This could be a good deal, but in its current situation, the current numbers, this is going to be a lot of work, and you're going to need somebody that is willing to put in the time, the effort, the work, the money to get this deal to where it needs to be. Now, if by chance the investors take a look at this deal and they kind of evaluate it similarly to how I just did, and they say this is not something that I'm really interested in, and you don't have a buyer lined up ready, well then I recommend that you sit down with the seller and have a heart-to-heart and tell them you have one of three options here. Number one, you increase the cap rate and justify the current price by getting a fourth tenant in there immediately. Number two, make improvements or repairs, increase the value of the property, and increase the rents to justify its current price. Or number three, leave it as is and realize that a seasoned investor is going to come in here and they're going to gouge you on the price, and you might want to consider even dropping it some. Now that's a hard place to be in, because there is potential value here, but in its current situation, an investor is going to make you pay for it. Now, in business or sales, one of the things that you always want to consider and think about is, who is my buyer? And in this particular situation, I feel like the wholesaler has one of two people that are going to buy this property. The first one is a D-class investor. And what I find with D-class investors is that have success is usually they're seasoned investors. They know what they're doing, and if they're coming in D-class, they're all about the money. And if they see this deal and they sit down and evaluate it, they're probably going to walk through the exact same process that I just did, and they're going to make you pay for the current condition it's in. They're either going to make you lower the price, or they're going to make you have improvements done to the property to get it to justify the price that you're asking. They're going to want you to increase the value of it. Now, you also have another buyer that I see. The second buyer could be the newbie investor that unfortunately doesn't know what they're doing, and they're going to come in, purchase this property, and this will probably be their first investment property and their last. A newbie investor might see this, see the low price, get excited and jump right in, but not have the knowledge, the experience, or the resources to get out of this property the potential value that it has. And unfortunately, I see it time and time again. It's actually very common for people to jump in, get in over their heads, and end up selling the property to break even or even lose money. And that's why so many people don't like real estate investing. One of the things that you need to make sure that you do is, when you jump into real estate investing, get yourself the proper education and knowledge to make good decisions on your investments. So in conclusion, that's my evaluation on the property. I personally would not buy this property, but I'm also not a D-class investor. I think that the numbers need to be tweaked. There's a couple little things, minor things that could be done to make this more appealing to investors, but in its current condition, at its current asking price, I see why there hasn't been a whole lot of activity. So I think that you can go ahead and make those minor adjustments to make this a more appealing deal and get this sold, so that way the landlord can move on. Also, if you are looking for cash flow properties, I currently have 4 properties that I have for sale. All of them cash flow positive. They're professionally managed. I have everything set in place. And If you would like to take a look at them, let me know. I have them available for sale on my website at www.ramrealestateinvesting.com. Also, if you want deal evaluations or you're looking for coaching, there is a contact me form on there where you can reach out. I can even do one-on-one consultations with you. Go ahead and check it out when you got a chance. And do me a favor, again, please subscribe, like this video. I appreciate you taking time out to listen to me. I hope this was helpful and you enjoyed it. This is Steve.